Well, welcome everybody to our first quarter recap webinar. We've got Mark Eibel with us with Russell Investments, and timely webinar, I think, today because we've got lots to talk about. Tariffs have been a thing. Let me see. We've had trade issues. We've got Fed issues. We've got a slowing economy. We've got market volatility. Yeah. So timely webinar to talk about all the things today. But Mark, glad that you're with us today. And Jared, thanks for joining us as well. Mark is with Russell Investments. And Mark, I don't know your exact role and title. However, I know you're a guru of markets. And we've had you on before, and I appreciate you joining us. Don't know if you guys can hear me. Yep. All right, here we go. But Mark, thanks for taking time out of your busy schedule. I know that there's never a shortage of things that you have to devote your attention to, but definitely appreciate you taking the chance to come on, provide some clarity to our clients about kind of where we've been, where we are, and kind of set expectations here for maybe the balance of the year. So thanks for being here.
My pleasure. Sorry, I'll respond to something really fast, and then we're all good.
You are totally fine.
All right. This whole personal life thing gets in the way of work sometimes. Okay. Uh,
Family first.
well, usually. But anyways, yeah, so let's kind of break this down. First of all, first quarter seems a long time ago, but we're going to talk about it anyways. So let's do the setup for things pre kind of April volatility and how things went, and then talk a little bit about that. The good news is first quarter statements, open them up, people. You'll be fine. Probably better than you think, because everything obviously in the news is very focused on your home equity market, US equities. So, you just think, well, I must be down 10%, 15% more. Keep in mind, you have a diversified portfolio, and a lot of these things we've talked in previous calls, all this other stuff that you own that maybe you didn't really know why or appreciate that you owned anything else, get paid off in first quarter. I mean, U.S. equities was really the only asset class that went down. International, which we'll talk about in a little bit, had a very strong quarter, outperformed the U.S. handily. Bonds did fine. In fact, the more conservative your portfolio, you probably did a little bit better than folks that had more equity, because you have less of the U.S. equity, more of fixed income, which was slightly positive year to date, through March at least. And then real assets, global infrastructure had a very good quarter. So you're pretty flat for first quarter, and you probably, think, well, that sounds pretty good compared to everything that I've been hearing. So that's kind of life as we knew it through March 31st, and then April hit. We've had some more choppiness. So we're going to talk about, well, first of all, let's go. I think Jared's on. I think he has access. Hopefully he has a presentation. And he probably knows. I want to go to slide 4 as kind of a starter here. That's a good sign. There we go. Can you enlarge it a little bit, Jared, if you can? I just want to make sure you're paying attention. Nope. Yep. There you go. There we go. Oh, not too much. Now we can't see the header. Okay. I'm just going to keep talking. There we go. That'll be fine. I think this is a time for everybody to just take a breath, and have some perspective, right? These aren't just charts anymore. You have lived this. I love timelines. And particularly when we go through choppier periods of, hasn't been too long ago that you saw a correction like this. Now they all have different causes, but I mean, take you back to 2008, systematic breakdown. Everything almost just kind of stopped working, right? Scary. 2020, global pandemic, turned our lives off, stayed at home, scary, right? This one, completely policy led. We know what's caused this market to go down. It's a lot of the tariff talks and other policies, and we'll get into that. The solution is kind of there if people really want to play it, if the administration wants to. We saw that last week. What happened when the tariff language eased up at all? Market rallied 9% in a matter of hours, right? I mean, so you can tell the market is reacting to the issue. So, but the reason I like this slide is this isn't the first time you've seen these kind of corrections. You have lived through them. Remember how you felt. Remember what you wanted to do and hopefully didn't do, which was dramatically change your allocation, get out of the market, because look what you see on the right-hand side. Now, I don't know what the next 12 months brings, but this is what the markets in all of those instances did the 12 months afterwards. It kind of makes sense. Market sells off, sets itself up for a rally, right? Buy low, sell high. But it's hard when you're in the moment. And every one of these events has a different cause. And yet, look what the outcome is in all of them. And I would argue that this one is a little bit more unique because it was basically policy self-imposed. I mean, in '08, it was the system breaking down, the Fed came to the rescue, right? 2020, again, pandemic healthcare related, the Fed came to the rescue, the system came to the rescue, right? So I don't know if the Fed's the answer this time because it's almost like a civil war between the monetary part of our government or our economy and the fiscal side with the administration. But just kind of take a pause, take a breath, and go, okay, been through this. This is such a short-term thing, right? We have a different deck that you completely can get your hands on called Navigating Volatility, which goes back to the 50s and shows all sorts of political things that have happened, economic things happen, all negative news. Market just kind of grinds its way up and it has these periods that blip down. Fed meets every 6 weeks. Earnings come out every 90 days. I mean, this is all short-term stuff, right? Elections are every 2 years, right? We say every 4 years, but they're really every 2 years. And we'll talk about that too in just a few minutes. You're going to live hopefully 20 to 30 years after you retire. That's the eye on the prize, right? Helps you get through a lot of these shorter term events. And I understand politics all gets involved. If you like what's going on, you got 18 months to get a lot of stuff done because the midterm elections are coming. If you don't like what's going on, in 18 months, America decides on if this is the direction they want to go. That's the beauty of this country is we get to decide all that. So we'll get there in a minute, but this is just kind of a nice setup slide just to remind us. You've seen this before. You've seen it relatively recently, just a couple years ago. I understand the sweat beads start going down your face when you start reliving some of these events. Keep in mind what happened afterwards, right? Take a breath, have some perspective. So I think a nice opening slide for some things we're going to get into here in just a few minutes. With that, and I'm going to keep going, Mark, until you interrupt me. So
let me real quick, Mark. Yeah, sorry, I was trying to unmute my mic.
That's
so
okay.
The newbie mistake. What, I don't know, 5 years later after we've been doing all this Zoom stuff, maybe I'll learn at some point. So what I heard you say, quick recap. Q1, not all bad. If you focus the headlines here at home in the U.S., bad, but international hard asset. I say hard assets, but you mentioned global infrastructure. You mentioned bonds. The other asset classes fared pretty well up until April, right?
Yes.
When the U.S. kind of, can I say, shot ourselves in the foot from a policy standpoint? Maybe
you can say anything you want to. We'll get into that in a minute.
All right. So maybe that's just the quick recap. But what I also heard you say is that periods like we're in now are not uncommon.
Correct.
We've seen them before. And it's not the end of the world because what's yet to come historically has been pretty good.
Okay, that's what history tells us. Yeah.
Awesome.
Yep.
So then I guess where does that put us as far as where we are now?
Yeah, so let's talk a little bit about U.S. non-U.S. A topic we've talked about on these calls before, an area that people have been questioning. Why do I need to own anything outside of my home country? And I always kind of fall back on a lot of things that are on this slide that I've talked about without using this slide before. And quite frankly, this is one of my all-time favorite slides because there's just so much stuff on it. So number one, we are about 2/3 U.S. equity. In our equity portion of your allocation, not your whole plan, but in the equity portion, about 2/3 U.S., 1/3 non-U.S. Still think the U.S. is the best growth story out there. We're not as expensive as we were, a couple months ago. So the valuations are becoming more attractive. But we're never going to put 100% of our money in in one spot. I've been doing this for 40 years at the beginning of my career. If I had done that, everything would have gone to Japan, who had it all figured out. We would have had a rough couple decades with that allocation. 10 years ago, it would have all gone to emerging markets after their 10-year run. Last 10 years would have been rougher for you. And right now, the viewpoint has been we'll just put it all in the US, right? So it always kind of rotates. Never going to put it all in one spot because as we've seen, even though we are the largest economy in the world, it's an easier to have more money here than anywhere else. So we do have more money here than anywhere else. There's reasons to have money elsewhere. So all this shows is some fun facts below it. If you want to see percentage of population, we're only 4%. Of the world economy, we're 25% of it. Some very popular ways of valuing, are we expensive or not? You can see that we're more expensive than others when you look at price you pay for earnings or book value. Our dividend yields are actually lower. Companies outside of the US tend to pay bigger dividends than the US. It's how they return money to shareholders. We do it as well as do a lot of stock buybacks, kind of financial engineering, if you want to think of it that way. Others don't do it as much. So, and in periods like first quarter, again, you're glad you have it. Now, I don't think overnight Europe or Japan or anybody else is all of a sudden, why do they outperform? And they outperformed by like 10% or more over the US. I mean, it was a clear-cut winner for the quarter. It's not as if I think they're this great growth story right now. They're just not the story, right? And particularly in Europe, to the negative, they've been the story for the last 10 years or so. Not right now, right? We're the story, and we're kind of the source of the volatility. So that's one reason I think money has moved to other parts. Number two, again, their stocks are really cheap. Number three, their dividends are bigger. Currency, which we'll get into in maybe just a second. The dollar weakened, and that helps your investments outside of the US, and I'll show that in a minute. And lastly, they just don't have as much technology exposure, right? Which has really hurt them over the last 10 years. We are the growth innovators in that space. The rest of the world is more manufacturing, cyclical focus. So those did better as money left technology names. So it hurt the US more and rotated into other areas. So it's just kind of a combination of all of those events. The bar is kind of so low in people's minds about the rest of the world that anything of just being not the news story and not being lousy is kind of a lift to stocks, right? So we're very comfortable with our 2/3, 1/3 allocation. We're not increasing, we're not chasing non-US, we're already there. We still like the US story. Again, separate from some of the policy issues. Unemployment is still, labor's still doing okay. Earnings season has started. Earnings season looks okay. It'll be interesting to see what forward guidance or what companies are saying moving forward in these more uncertain times. We don't think we would go into a recession. Maybe we will now, but it's because the consumer is getting a little anxious about all this stuff. And remember, 2/3 of our economy is you and me spending. So, but separate from all that, we still like the US story better. So this is just kind of a nice one pager on why we have our portfolios broadly allocated the way we do, and why we're also not changing it right now. One area I do want to hit on really quickly, Jared, if you can go to the currency slide, I'm going to go to that one next, and then we'll move on to some fun policy stuff. Go to the next one. I know there's a lot on here, and I just want to walk you through it. So this just kind of shows the impact that currency can have on your non-US investments. Rule of thumb is basically when the US dollar weakens, which it did recently and might continue to do so as the rest of the world is starting to question maybe a little bit of some of the things in our world. When you make money outside the US, you're translating it into something that's cheaper, right? Just think of currency as a, box of cereal or anything else. If it's cheaper, I can buy more of it, right? So what you see in the right-hand corner on the bottom, I'm going to use Japan as an example. In the very lower corner, Japan, if I lived in Japan and I had my investments in yen, I was negative 4.4% last quarter. But for a US investor, you see when I put it in US dollars above, well, I actually made 0.5%. Why? Because I got a 5% weakening of the dollar versus the yen. So it helped me as an American investor. So I didn't earn -4, I earned +5. So the one in the middle there, that MSCI EFA, it's kind of the S&P 500 of non-US stocks for benchmark, is up around 3% if you add up the local currencies around the world. But as a US investor in the top part, you see that I got 7. Why? Because the dollar weakened and I got a currency kicker. So in periods, it's nice to own some non-US stocks because currencies are just like anything else. They go up in value, they go down in value. The dollar has been really strong for a long period of time, probably due to sell off a little bit. You got a little bit of a performance kicker there. Currency is always an interesting thing. Politicians always run on strong dollar, right? Who wants to come out and campaign on, I'm all for a weak dollar? That just doesn't sound very good politically. However, in reality, there are some benefits, and this is one of them. Your goods are cheaper to the rest of the world. If your currency, if the rest of the world is buying U.S. goods, well, if the dollar's cheaper, they're getting more bang for their buck, so to speak. So there are benefits to a weaker or more expensive currency. But as it relates to your performance returns, when you see weaker dollar, and your mind probably goes to, well, that always has to be negative. Keep in the back of your mind, any of your non-US investments probably just got a little performance kicker, and this is just a little way to kind of show it. So that's probably enough in the weeds about US and non-US. I've just been putting off the tariff conversation as long as I can. Mark, any comments on that before we move on to the thing that everybody knows that we're going to talk about?
No, I actually really enjoyed the way that you phrased the whole currency discussion, Mark. I don't know that I've ever seen it put this succinctly
I
before.
try to simplify it because as Americans, we're lousy at currency because the dollar is so dominant in the world. I mean, we freak out when we go to Mexico or Canada. How does this work again, right? The rest of the world is so closer to each other, always has to deal with currency exchanges, and the
Right.
dollar is so dominant. 80% of world trade still done in the dollar that we are sheltered because we have the world's reserve currency. So anytime currency is in the conversation, and I feel like I have to go back to my old CFA books and kind of look at it. So I try to simplify it because I struggle with it. And I think a lot of us probably do just because as Americans, we were spoiled with it. It's harder for us to travel to lots of other parts of the world because we're so far away from them that we just don't deal with it that much in an early age where it's just second nature to most of the world. They have to
Right.
translate everything. Their currency always gets translated into the dollar. So,
Yep.
try to simplify it. Yeah.
No, I think maybe just the two or three bullet point recap. Internationals are doing okay. The U.S. still continues to be the source of it is the source of the volatility now. As the dollar weakens, it has boded well for international stocks because everything converts back through the dollar, right, at cheaper prices for them. So because it costs them less, when I say them, international
Right.
economies to purchase U.S. goods, then that also has I would, as indicated here, a positive impact to their earnings as well, I would think.
Yeah, currency is a great shock absorber. If your economy gets really strong, I think of the US for so many years, so much capital flows here. It makes your currency more expensive and kind of cools you off a little bit. If you're a really weak economy, and what do you usually do? Your currency is really weak. I always think of the example of like Greece when it had its hard times, right? With Greece had a tough economy, its currency got so cheap. What do? We went on vacations to Greece, right? And so because it's helpful for us, and it helps the local, and then it brings money into a country, makes their economy stronger, and their currency tends to strengthen. So the currency and the economic impact kind of offset each other sometimes. They're kind of this built-in shock absorber in the world, which is why in Europe, now that they all share the same currency, some of those effects have gone away, right? Greece is sharing the same currency as Germany or, Italy or others that are stronger economies. So they don't get quite that lift that they used to. But in theory, that's the way that it works. It's just a nice little built-in balancing act. It prevents the strong from getting too strong and the weak from getting too weak because there's deals along the way that can be made when you take currency into effect. Enough said.
No, I really enjoyed it. So
All right.
enough of that in what everybody signed on here to hear
Yeah,
about today.
let's go to tariffs and
Tariffs.
policy. Yeah, so let's skip the fixed income slide, Jared, and go straight to that.
And
Um,
and Mark, not
so
to derail you too much, I might be having technical difficulties on my end. I'm just seeing our charts are a little misaligned, so I'm going to pull up a different deck just to make things a
all
little
right.
bit prettier, if that's all right.
All
Yeah,
right, well, that's
go
fine. I mean,
for it,
this one
Jared.
was fine. That's all good. Just go to the tariff, yeah, 21, and then I'll probably hit on 22 and almost be done with slide part of it. Okay, so as it relates to tariff, and I broaden tariffs out to be, I mean, there's four main policy areas, right? So there's tariffs, there's immigration, there's tax policy, and there's deregulation. Now, two of these, and this is just simply pros and cons of tariffs. Now, I don't know how to assign a weight to what's really driving this conversation. Is it because it's a revenue source? Yeah, that's part of it. We'll get into that in a second. Is it a negotiating tool for trade agreements around the world, or particularly between Canada, Mexico, and us? Absolutely, because that one's up for renegotiation. Same with China. Or is it just a philosophical belief of this administration that the United States has been cheated in trade for years, and that's what they believe? I think all three of those are true. I just don't know what percentage to allocate to what one is more important than the other, because there's only one guy that knows how those three get allocated, and it's the president, and I'm not him. So that's why this is in conversation. So is it a revenue source? Yeah. It will bring in probably. We have an exhibit. We'll get to it in a second. As high as 800 billion, but I think the reality after everybody, kind of tariffs each other back and forth, 300 or 400 billion, which is a big number. I get that. It is wanting to bring more manufacturing to the US. And I think in some ways it will be successful doing that. Certainly see chips coming back. But even if production comes back to the US, are we going to become the manufacturing power we were? Probably not. Why? Because a lot of it is automated. Now, that doesn't mean it's not a boost to the economy. Obviously, you got to buy all that equipment that's automated. But as far as a jobs, big manufacturing, probably not. Keep in mind, if you're running an auto company, $70 an hour for US auto workers, $40 an hour for Canadian auto workers, $5 an hour for Mexican auto workers. Where are you putting your production? Right? I mean, that's just the reality of it, right? So yes, it will bring back some production, but not maybe as much as people think. But any production you bring back to the United States might have an inflationary lift to it. That's why the market is kind of concerned about it. When you pair it with immigration, it really kind of gets interesting. And I think immigration longer term might actually be the bigger issue to keep your eye on, right? Border is closed, campaign promise fulfilled, right? Boom, right, number one. But keep this in mind. If you look at where the labor supply over the last number of years has come from, this wonderful 150,000 to 250,000 jobs that we have added through both sides of the aisle for years, over half of that comes from immigration. So if you truly keep the border closed, and I do think there will be a process for bringing people in legally, but we got to get to that point. If you close off your labor supply at the same time that you tariff and encourage more production to come home, that's the inflationary fear the market has. Now, what do I think will happen? I think the tariff policy gets relaxed in a lot of places, and it's all about us versus China, which quite frankly, it's been for a while. Trump first term, tariffs China. Biden kept the tariffs on both sides of the aisle. It all kind of comes down to us and China, I think, ultimately. I think the tariff policy calms down. I also think the immigration policy will come up with new rules and get relaxed too, right? So as two of those kind of calm down, those are the two main issues that the market, even with the election results, knew was probably more the two negative impacts on the market. The more positive ones, what's going to go on with tax cuts and what goes on with deregulation. We haven't even gotten to those yet, right? Midterm elections 18 months away. The pivot from this focus at this level on tariffs and immigration has to get to those other two issues, or midterms could be interesting for the Republican side of the aisle. Now, I know every time you win an election, you think you will never lose another seat anywhere ever again. History's not on your side. Even if things are going great, party in charge tends to lose seats in the midterms, and Republicans lose any seats, can't get a lot of stuff through in the last 2 years. So you've got to get your entire agenda through in the next 18 months, right? So the level of activity is going to stay at this level, but the pivot to some of these other issues has to happen, because as we see in the markets, we see with corporations, we see it in consumer confidence measures. We're 2/3 consumer led. People are starting to spend less money. Just take a breath. We'll see where the tariff policy leads to. We've already seen when you get any sort of relief, what happens in this market. Immigration will be an interesting one to keep an eye on, and then pivoting to some of the other issues. So let's go to the next slide really quickly. It relates to this. This just kind of puts it into a broader picture. I know there's a lot of details on here. Tariffs are on the far right. If you tariffed all the goods at the rate that's, I think, higher than it will be, yeah, you could raise 800 billion. Now, that doesn't take into account that the other side also tariffs you and there's offsets. So realistically, you probably make 400 billion or so maybe in tariffs, which is a big number. I understand it. I understand the revenue argument. However, look at the left-hand side of the page. That's the US budget, 7 trillion. And there's the breakdowns between Social Security, Medicare, Medicaid, defense, interest payments. 75% of that far left side is basically untouchable, right? No politician wants to really touch those very much. So in order for the tax policy, and I do think the tax cuts will stay as they are now, it'll be interesting to see if there's spending cuts because, again, you can't really touch 75% of it. And not enough revenue is going to come in from the tariffs. You're still going to run deficits no matter what. And if you just, and the reason I say, yes, it's a big number, but keep in mind, it's not as big as you might think. If it's got a B behind it, a billion versus a T for a trillion. I don't think people understand how big a trillion is. It takes 32,000 years to count to a trillion. One number per second, 32,000 years. We have 7 of those in our annual budget. That's how big the budget is, right? So as you hear these kind of things, just kind of, again, put it in the context of, yes, it's a revenue source, but there has to be more to it than that. I do think it's a negotiating tool, and we're going to see that. We're probably over the next 90 days, we're going to see a lot of that as countries come around and negotiate. And then ultimately, I just think it comes down to our view with China, China with us, and that's where the action will take place. But quite frankly, we've seen that before. We're kind of used to that, and that's probably not going away. So just buckle up. There's a lot of policy that's happened, and there is a lot of policy coming, and it's all got to get done. And I know the president's not on the ballot box, but some of this stuff needs longer than his term to really see it through. So he has a huge interest in making sure his party stays in charge for the handoff. He knows when the midterms are. He knows which issues the market is more negative on, and he knows which issues they're more positive on. You know that pivot's probably going to come. In some regards, I mean, you're down maybe a couple percent in a balanced portfolio year to date with all of the drama in the 2 issues to a bigger extreme than most of us thought. And those are the 2 that have been in the headlines. I think the market has actually held up pretty well. And again, your diversification has helped made it a little easier to own. So a lot of detail on this page, but some interesting buckets on where all the money is spent. And again, I don't think any politician until absolutely forced is going to really deal with anything on the benefit side because basically it's political suicide. I think about Europe. When did Europe fix their reliance on Russian energy? When the war came to their border. They could have done 20 years of committee meetings and they would have come to no resolution. When did they get off Russian oil? When the crisis came to their border. That's what it'll be like here with benefits. Some politicians down the road will have to deal with it. And until then, we're just going to borrow. And quite frankly, at our 10-year treasury at 4.3%, there's so much demand for it. We get away with it. We get away with it longer than most others do because of who we are and our size in the world. So anyways, I sidebarred there a little bit, but let me take a breath before I get into kind of a closing slide here because there's a lot to process there. Great summer for you to spend time with the grandkids and a great summer for everybody to get a hobby because the pace isn't going to go away. And even if you love what's going on, the pace is exhausting, right? And if you don't like what's going on, it's debilitating, right? I mean, that's where our politics all get involved. 18 months, we'll decide, and then we'll move forward from there. That's the way it works. But I'll just leave before handing it back over to you, Mark, on this one. Keep in mind, politically, half the time in life, your side of the aisle wins. Literally, it's 50%. You can go back to the 20s, 30s. Half the time you win. Half the time you lose. 72% of the time, the market goes up. So you can get out of the game. You'll be out of the game half your life, no matter which side of the aisle you're on. You'll miss too many of the returns. And it's really hard to get back in the game because this recent environment proved it. The market's down 15%. You got a 25-year time horizon. Why aren't you putting more money to work? Because you're worried about what's going on today. And it's going to be worse and it's going to last longer. That's human nature. And then you get these bounce back days that are so sharp and so fast, you miss them. It's easier just to stay in the game and worry about longevity than it is to worry about 2-year cycles, Fed meetings. Powell's talking right now, probably moving the markets. I mean, every day there's something going on. So, Mark, where do you want to go on that one?
Yeah, I think the summary points that I heard, Mark, were one, markets don't care about Republican or Democrat. I know we all have our deeply held political convictions that we want to see have play out and we have our own parties we want to see elected that we align with from an ideological standpoint or just philosophical standpoint, social standpoints, whatever the case may be.
Mm-hmm.
But it would, I think, serve us all a lot of good, which is what I try to do, is to take those lenses off when we start making decisions with our portfolio, because Wall Street doesn't care. They don't see it. They don't see the world in terms of Republican and Democrat. They see the world in terms of earnings.
Right.
In which case, policy, like we've been talking about, has a big implication on earnings, tariffs, trade, etc. And yeah, so the other bullet point that I heard was that with regard to spending and some of the budgetary items, we are where we are. Not much is going to happen with it. So as much, I think, talk as there has been about Social Security and Medicare reform and changes, I tend to agree with you, Mark. I mean, nothing's going to happen until it's a crisis, which is 2030, give or take.
Right. What'll be interesting is the Medicaid one, right? So the Medicaid one gets talked the most. I mean, and there might be some trimming to defense, particularly depending on what goes on with Russia and Ukraine. There might be some money to be saved there, but not, I mean, not enough to balance the budget. But Medicaid will be an interesting, right? Because it's the talk is, well, we're going to go after the fraud in Medicaid. And of course, I mean, both sides of the aisle, no one's going to come out and say, well, wait a minute, I'm pro fraud, right? So everyone agrees, okay, well, let's go after the fraud. But keep in mind, in political season, what will likely happen? You go after Medicaid, you're going after the fraud. What are the advertisements going to look like? Government's got their hands in your Medicaid, right? Not going to talk about what it's going after, right? I think back when Paul Ryan remember when Paul Ryan had his plan on here's how you fix like Social Security over decades and you phase it in and this is what you do. What were the advertisements? 20 minutes later, it's grandma pushing grandma over the cliff in the wheelchair, right? So that's the difficulty with even going after things that you'll go, well, who would be against that? It kind of gets politicized. It just makes it hard, right? And I think you're starting to see, right? Is Musk probably going to fade from, the saving, trying to find tax savings? I think so, right? Because it's hard. He's going to say something, whatever cabinet member is represented by that group is going to say no, and then it goes to the courts. And he's probably going to go, look, it's easier to run my 7 companies than it is to try to get government to save money, right? So I think that's going to be the challenge. And keep in mind, you could fire every federal employee out there. You're still in the B, not the T, as far as how much that would save. And what are the ramifications of that? And we all think we work harder than everybody else, right? Everybody else in the world is lazy relative to me. What happens when you fire mass amounts of people? They don't go to Starbucks the next day. They don't take the trip on spring break. They don't go to dinner on Friday night with the family, right? So you want to send your economy into a recession faster? Fire millions of people who then no longer are becoming consumers, right? Every action has a reaction. Every policy, the other side. Look at this, fire IRS workers. Great. Now all these people who say I'm not filing my taxes because I won't get audited. So now the revenue coming in is gone in order to save money with the workers. And again, so just everything's harder than we think. And we still have the best system in the world. Kind of amazing to think about. So anyways, let me get to my last slide and then we'll go anywhere that you want to, Mark.
Right. Before you get there, Mark, let me just prompt anybody on with us to load in questions to Q&A or text chat. We'll circle back to those at the end.
We will. So this one kind of rhymes and looks like the first one. So this again just looks at the last 40 years. So there's the worst, this isn't calendar year returns, the worst rolling 12-month periods are on the left-hand side. And the middle just says based on how you're allocated, this is what you felt, right? So obviously it's more dramatic the more you go down, because the more you go down, the more you have in stocks. 100% stocks in the bottom, 0% stocks in the top. Right-hand side, here's how the best 12 months did for all of those allocations. But the area that I zero in on is the blue, right? So that's the portfolio mix. What is the average that you get if you're 100% fixed income in the top, all the way down in 10% increments to 100% equity? Now, most people tend to have their money in that moderate or balanced range in the middle. Too conservative, might not fund their longevity in their retirement. Much higher in equities it's hard to live with when you go through markets like this. So the money ends up in the middle, right? And that 6, 7, 8% return. I mean, that's what it's really all about, is it's getting that planning assumption return. Now, sometimes the beauty about a diversified portfolio is You don't even necessarily have to always, you don't have to be right. You just have to be there, right? Look at the last 10 years. All your money was made in US equity. 10 years ago, we didn't know it was going to play out that way, right? And it's the biggest weight in the portfolio. And so you hit your planning assumption. 10 years before that, US equity was not the best place to be, right? So where'd you make your money? International part of your portfolio, fixed income, kind of like what you saw in first quarter. You made it in other places, you ended up with 6 or 7 or 8%. So because you own it all, and we'll turn the dials up and down a little bit, but because you're in the game, you don't even have to be right on, oh, I think it's going to be the US. I don't know who's going to win for the next 10-year period, but if you own it all, you're in that range. And when it really comes down to what's the most important thing is hitting these planning assumptions so you can retire when you want to, and you can take care of longevity. So you combine the great advice that you get, you manage your taxes, and you stay in the game. You make tweaks where you need to, but just don't blow in and blow out mentality. And that tends to happen in periods where we're stressed out, which is now. Take a breath, look at history, look at your own history in these down markets. Think about how long you're going to live. Go play with the kids, right? So I like ending with this one. It rhymes with the first one. The stuff in the middle, I know a lot of it was in the weeds. Some of it's of interest, some of it's not. There's like 10 other slides I could have gone through, so count your blessings. But these have been the areas I've been honing in on with calls, and would love to open it up and see if there's any questions.
Yeah, I currently don't see any, so maybe I'll just buy a little bit more time, Mark, before we wrap it up. But so my
That's good because
takeaway,
I've got like 4 minutes before my next call, but no, I'm good.
I will keep it brief on my recap here. But so diversification still works, right? It's not dead, as many were saying for the last
Right.
decade.
Yep.
Periods of volatility happen, and it's not about the volatility. The volatility doesn't derail plans. It's when you don't stick to the plan. That's what I heard you say. Maybe different words.
Mm-hmm.
And yeah, cycles are going to happen, and it's about the long term.
That's
maybe
it.
a repeat of what I just said. But
Yep, that's it. So and prepare. This pace is not going away.
yeah,
Again, look at all that has to happen between now and again. You just got to think of it. If you're an incumbent, it's a 2 year term. Anything you can get done in the last 2 years is kind of a bonus, right? So it's going to stay at this pace. And there's going to be lots of different news, but just watch. It'll be interesting to see. I bet the tax stuff, that'll be the summer pivot. That'll happen before everybody goes back away, back to their home states as Congress. But the pivot to those areas, deregulation tends to be market friendly. Why? Because it's an expense, and if my expense is lower than my earnings, to your point, go up. I mean, that's it. It's as simple as that.
yeah.
So look for the pivots and look for relaxing of the current policies a little bit in language. And we'll do this call again and we'll see what hand we're all been dealt. But and again, take a breath and look at your portfolio and go, well, I've only given away like what, a couple months worth of returns. It's not like you've lost like 20 years worth of returns. I mean, you had a phenomenal last few years and you've given some of it back. So that's always a good kind of perspective.